Dear students of Class 9 Business Studies English Medium Morning Shift, I am Mohammad Maizul Haq Khan. Again, I have come back with another topic of capital budgeting. In the previous class, I discussed about what is capital budgeting, what are the applications of capital budgeting, and process of capital budgeting. In that class, I gave you some homework. What is capital budgeting? What is the first step of capital budgeting? Why is capital budgeting assumption based? And why is driver solution done? I think you have done your homework. Today, I would like to discuss about techniques of capital budgeting. That is the way through which capital budgeting decision is done. Different techniques are used in guiding the capital budgeting decision. I have mentioned these in the sheet. Number 1, ARR, accounting rate of return or average rate of return. Number 2, payback period or PBP. Number 3, NPV or net present value. Number 4, IRR or internal rate of return. ARR and payback period both are non-discounted cash flow method, as time value of money is not considered here. And NPV and IRR is discounted cash flow method, as time value of money is considered here. But we shall discuss only two methods, ARR and payback period. Today, I would like to discuss about ARR. What is ARR? Average rate of return is defined as average annual net income after tax divided by average investment. In case of ARR, net profit is being considered instead of expected cash flow. Now, how can we evaluate the long-term investment decision making through ARR? That means the decision criteria of ARR. The more the ARR, the better the project. In case of 2 or more projects, the project whose ARR is higher, the project is acceptable. If project is financed by taking loan from the bank, then bank demands some interest. If the ARR is lower, then the interest rate of loan will not be granted by the bank. For some companies, minimum ARR remain fixed by the company's administrative decision or company's authority. If actual or calculated ARR is greater than minimum ARR, then project is accepted. And if actual or calculated ARR is lower than minimum ARR, project is rejected. Say for example, ABC company has set the standard in case of evaluation of project by ARR. they set the standard minimum ARR in case of choosing a particular project is 30%. If the calculated ARR is lower, then minimum ARR, then project should not be accepted. That is, in this case, calculated ARR should be more than 30%. But if the calculated ARR is greater than 30%, in that case, project will be accepted. In case of more projects, projects are arranged in an order by following the above principle. Among these, necessary number of projects are selected by considering the financial capability. Now, how can we calculate ARR? Necessary formula of calculating ARR I have given in the sheet. Basic formula of ARR, average net profit divided by average investment into 100. And average net profit equal to summation of different year net profit divided by number of year. Average investment equal to initial investment plus 0 divided by 2. 0 means salvage value. As salvage value is not mentioned or is not given in your book, that's why 0 is mentioned here. Salvage value means the value which is received from the project at the end of the lifetime of the project. Depreciation, initial investment minus 0 means salvage value divided by lifetime of the project. For calculating ARR, in this case I have given creative questions. Mr. Russell Ahmed is the finance manager of Islam Group of Company. He is interested to invest in the two projects named Nilachal and Nilgiri having maturity of 3 years. The initial investment of the two projects is Taka 5 lakh. The detailed information of the two projects are given below. Project Nilachal sales Taka 1 lakh in the first year, Taka 2,50,000 in the second year, Taka 4 lakh in the third year. His cost is Taka 30,000, depreciation is Taka 25,000, current cost is 25% on sales, tax rate is 30%. Project Nilgiri, estimated sales in the 3 years are Taka 1,25,000, Taka 2 lakh, and taka 4 lakh respectively. Fixed cost is taka 32,000, depreciation is taka 25,000, current cost is 26% on sales, tax rate is 30%. Question number A, what is capital budgeting? B, explain the first step of capital budgeting. Calculate the net profit of Nilachal project. C, D, which project should be accepted on the basis of ARR? Answer logically. At first, we have to notice what is given for calculating ARR, because ARR can be calculated from sales, net profit or profit after tax or profit before tax, cash flow before tax or depreciation and profit before tax, and cash inflow. Here in this problem, sales is given as, in case of ARR, net profit is considered instead of expected cash flow. That's why for calculating net profit, we have to deduct at first current cost from sales. Current cost, the cost which is changed with the changes of volume of production, that is raw material cost, wages, transportation cost, utility cost. Then we have to deduct fixed cost, the cost which is not changed with the change of volume of production, that is fixed cost, salary of employees, factory or office rent, etc. Then we have to deduct depreciation, and after deducting these three, we can get profit before tax or taxable income, that is the income on which tax is imposed, that is taxable income or profit before tax. And after that, we have to deduct tax rate. Once tax rate is deducted from the taxable income, then we can get net profit or profit after tax. After that, we have to find out the average net profit. As we calculated here net profit, then in D we have to calculate average net profit from the information of C. Here summation of different year net profit divided by 3. Then average investment, initial investment was 0, initial investment taka 5 lakh divided by 2. Then we will put the information in the basic formula. So the ARR of Nilachal project is 37.10%. The same way, we have to calculate the ARR of Nilgiri project, and since there are two projects here, then after calculating the ARR of Nilgiri project and the project whose ARR is higher, that project should be selected. So it is your homework, that is homework is to calculate the ARR of Nilgiri project. The answer of Nilgiri project is 37.56%. Definitely in this case, project Nilgiri should be accepted, as the error of project Nilgiri is higher than that of project Nilachal. In this way, we can calculate error from cells. And besides that, we can also calculate error from, I have already mentioned, net profit or profit after tax. And in this case, you need not to calculate net profit. Net profit is given, and then if profit before tax is given, then only you have to deduct tax. Then you can find net profit. And if depreciation and profit before tax is given, then at first you have to calculate. At first you have to deduct depreciation, and after deducting depreciation, you will get profit before tax, and after that you have to deduct tax rate. Then you will get net profit. It may be mentioned here that in case of error calculation, you have to have net profit. So net calculation of net profit is the prime consideration here. Now I would like to give another homework, complete homework. More creative questions. Mr. Sabir Rahman is a finance manager of Delta Fashion Limited. He is interested to invest one of the project from the two projects named Padda and Jumuna, having maturity of 3 years. The initial investment of both projects is Taka 2 lakh. The detailed information of the two projects are given below. Project Padda, expected sales from the project in the next 3 years are Taka 75,000, Taka 90,000 and Taka 1,20,000 respectively. Current cost is 25% on sales, fixed cost is Taka 20,000, depreciation is Taka 15,000 and tax rate is 35%. Project Jamuna, expected sales from the project in the next 3 years are Taka 80,000, Taka 1 lakh and Taka 1,30,000 respectively. Current cost on sales is 20%, fixed cost is Taka 30,000, depreciation is Taka 25,000 and tax rate is 35%. Question A. What is discount rate? B. Capital budgeting is applicable in product diversification. Explain. C. Calculate the cash inflow of the project Padda stated in the stem. Which project should be selected by Mr. Sabir Rahman based on the average or accounting rate of return mentioned above? Give your opinion with logic. Okay, thank you very much. I think you will do your job properly. See you again with another topic. Thank you very much.